On January 29th, 2026, the financial world held its breath. In the span of just 1 hour, the gold and silver markets experienced a cataclysmic crash, a freefall so sudden and so violent that it vaporized an estimated $6 trillion in value. This wasn't a gradual decline or a market correction. This was a digital avalanche, a black swan event that left traders, investors, and entire nations reeling. Today, we're going to dissect what happened, why it happened, and what this unprecedented event tells us about the very nature of our global financial system. So, what exactly unfolded on that fateful day? For years, these precious metals have been the bedrock of investment portfolios, a safe haven in times of uncertainty. Then, without any obvious warning, the floor gives out. The price charts, which normally show gentle waves, suddenly transform into a sheer cliff. We're talking about a plunge that happened in minutes, not days or weeks. Gold, which had been trading at historic highs, saw its value slashed. Silver, often called poor man's gold, suffered an even more brutal percentage drop. The speed was terrifying. Automated trading systems kicked into overdrive, triggering a cascade of sell orders that fed on each other, creating a death spiral of price collapses. The sheer volume of selling was astronomical, overwhelming any buying pressure and sending shockwaves through every major exchange from New York to London to Shanghai. It was a digital stampede, and in the chaos, trillions of dollars simply ceased to exist. To understand how a $6 trillion wipeout could happen in 60 minutes, we need to look at the perfect storm of factors that converged on the market. It wasn't just one thing, but a chain reaction of vulnerabilities. First, let's talk about market pressure. Whispers of a potential global liquidity crisis were circulating. Major central banks had hinted at tightening their monetary policies faster than expected, which made holding non-yielding assets like gold and silver less attractive. This created a tense environment where investors were already on edge, with their fingers hovering over the sell button. Then we have the catalyst, the spark that lit the fuse. While definitive proof is still debated, compelling evidence points to a massive coordinated sell-off by one or more major institutional players. This could have been a sovereign wealth fund, a massive hedge fund, or even a central bank discreetly liquidating a portion of its reserves. When a whale of that size decides to dump its holdings, it doesn't just create a ripple, it creates a tsunami. Their initial sell order, likely in the tens of billions of dollars, would have been large enough to breach critical technical support levels on the price charts. This is where the algorithms take over. High-frequency trading algorithms, which execute millions of trades in fractions of a second, are programmed to react to these breaches. Once that key support level was broken, countless automated systems simultaneously triggered their own sell orders. This is the domino effect in action. Human traders, seeing this sudden, inexplicable plunge, panicked. Margin calls were triggered across the board, forcing leveraged investors to sell their positions to cover their losses, adding even more fuel to the fire. It became a self-fulfilling prophecy. Prices were falling because prices were falling. The panic was amplified by social media and financial news networks, which broadcast the collapse in real time, spreading fear and uncertainty at the speed of light. The market's own mechanics, designed for efficiency, had turned against it, creating a feedback loop of pure, unadulterated selling pressure that the system simply could not handle. So, a $6 trillion hole appears in the global balance sheet. Countless individual investors, who had put their life savings into what they believed were the safest assets on Earth, were wiped out. Retirement accounts were decimated. Hedge funds and investment banks that were heavily exposed to precious metals faced catastrophic losses, with some teetering on the brink of insolvency. This raised the terrifying specter of systemic risk, the idea that the failure of one major institution could trigger a chain reaction, bringing down the entire financial system like a house of cards. Remember the 2008 financial crisis? The fear was that we were staring down the barrel of something similar, but this time originating from the commodity markets. Furthermore, nations themselves were hit hard. Countries that hold significant gold reserves as part of their central bank assets saw their national wealth plummet overnight. This had direct implications for their currency stability and their ability to conduct international trade. The US dollar, paradoxically, strengthened in the immediate aftermath as panicked investors fled from all other asset classes and rushed into the perceived safety of cash. This sudden currency shift created chaos in emerging markets, which often have debts denominated in dollars. Their debt burdens effectively increased overnight, pushing them closer to default. The crash of gold and silver wasn't just a number on a screen. It was an economic earthquake that shook the very foundations of global finance and threatened to unleash a worldwide recession. Investor confidence, the invisible glue that holds markets together, was shattered. If gold and silver aren't safe, then what is? So, what are the main takeaways from this historic and terrifying event? First and foremost, the crash of January 29th was a brutal reminder that no asset is completely immune to risk. For centuries, gold and silver have been considered the ultimate store of value. a hedge against inflation and chaos. This event proved that under the right set of extreme circumstances, even these ancient safe havens can experience volatility that rivals the most speculative tech stocks. It forces us to reevaluate the very definition of a safe asset in our modern, hyper-connected, and algorithm-driven financial world. The second key lesson is about the speed and ferocity of modern markets. The entire $6 trillion collapse happened in the time it takes to watch a TV show. This illustrates the incredible power and potential danger of high-frequency trading and algorithmic systems. While these systems provide liquidity and efficiency in normal times, they can also create and amplify instability at a speed that humans simply cannot comprehend or react to. It highlights a critical vulnerability in our market infrastructure, a system largely run by machines that can spiral out of control before any human regulator can intervene. The flash crash was a wake-up call for regulators worldwide to re-examine the rules governing automated trading and to build better circuit breakers to prevent such cascades in the future. Finally, this event underscores the interconnectedness of our global financial system. A crisis that began in the commodity pits of Chicago and London instantly threatened the stability of banks in Europe, currencies in Asia, and national economies in South America. It showed that financial risk can spread like a virus, ignoring borders and asset classes. The reliance on a few key assets, the concentration of holdings in the hands of a few large players, and the herd-like behavior driven by fear can combine to create a system that is far more fragile than we might believe. The Great Crash of 2026 wasn't just a story about gold and silver. It was a story about the complex, powerful, and sometimes terrifying system we've built, and a stark warning about the risks that lie hidden just beneath the surface. It forces us all to be more vigilant, more diverse. Hey everyone, and welcome back to the channel. Today, we're diving deep into one of the most dramatic market meltdowns in recent memory. A story of how trillions of dollars vanished in the blink of an eye. This wasn't just a regular market dip. It was a full-blown liquidation cascade that sent shockwaves through the global financial system. So, grab your coffee, get comfortable, and let's unpack the day the precious metals markets imploded. For months, gold and silver had been on an absolute tear. We're talking about a spectacular rally where gold surged roughly 160%, and silver, not to be outdone, skyrocketed an incredible 380%. Investors were euphoric, and it seemed like the only way was up. But here's the thing about markets. When everyone is on the same side of the boat, it doesn't take much to tip it over. Prices had become what analysts call overextended. There just wasn't much room left for a sustained climb without some kind of pullback or correction. The buying pressure that had fueled this incredible run began to slow down, and as it did, the risk of a sharp drop grew exponentially. The stage was set for a disaster. And then it happened. The trigger was something called margin calls, and it's a concept that's absolutely crucial to understanding this story. Many traders, especially in the futures markets, weren't just using their own money. They were using leverage, borrowing money to amplify their bets. We're talking about massive leverage, sometimes as high as 50 to 1, or even 100 to 1. This means for every dollar of their own capital, they were controlling $50 or $100 worth of gold or silver. While this can lead to massive profits when prices go up, it creates catastrophic risk when they go down. So when gold and silver prices began to slip, even just a little bit, it triggered a domino effect. The automated systems at the exchanges detected that these leveraged positions were losing money and immediately issued margin calls. A margin call is basically a demand from the broker for the trader to deposit more money to cover their losses. If they can't come up with the cash immediately, the broker has the right to force sell their positions to prevent further losses. This is exactly what happened, but on a massive scale. Thousands of traders received margin calls simultaneously. This wasn't ordinary selling. This was forced selling. A flood of sell orders hit the market all at once, creating a tidal wave of downward pressure. This massive, forced selling pushed gold and silver prices down much, much faster than they would have fallen under normal market conditions. It became a self-reinforcing death spiral. The forced selling pushed prices lower, which in turn triggered even more margin calls and more forced selling. The speed and scale of the drop were breathtaking. Gold plummeted by more than 8% in a shockingly short period. To put that in perspective, this single drop erased over $3 trillion in market value. Silver got hit even harder, falling by more than 12% and wiping out around $760 billion. When you factor in the ripple effects on other assets linked to precious metals, the collective loss in global market value was estimated to be over $6 trillion. Trillions of dollars, gone in a matter of hours, and in some cases, minutes. This wasn't just a precious metal story either. The chaos quickly spilled over into other markets. Why? Because when a crisis hits, investors everywhere rush to do the same thing, reduce risk and raise cash. This is often called a flight to safety, but in this case, even the traditional safe havens were the source of the problem. This synchronized sell-off across different asset classes amplified the shock, creating a global market panic. Everyone was selling everything all at once. To make matters worse, there were other structural factors at play that threw gasoline on the fire. Some analysts pointed to sudden changes in margin requirements on major futures exchanges. Essentially, the exchanges made it more expensive to hold leveraged positions, which forced even more selling. At the same time, some markets, particularly in China, implemented emergency trading halts. While designed to calm markets, these halts can have the opposite effect. They reduce liquidity, the ability to buy or sell an asset easily, just when selling pressure is at its peak. This trapped many traders, leaving them unable to exit their positions as prices crashed around them. It was the perfect storm of high leverage, automated selling, and structural market failures. So, what happened in the aftermath? Once the dust settled, market experts began to analyze what had just occurred. A key consensus emerged. This sharp, violent drop wasn't necessarily a fundamental collapse in the value of gold and silver. It wasn't because people suddenly decided that these metals were worthless. Instead, it was a brutal demonstration of the structural weaknesses in the modern financial system, particularly in the highly leveraged paper markets. The underlying physical demand for gold and silver coins and bars hadn't really changed. This brings us to a fascinating and important distinction: the difference between the paper market and the physical market. While the paper prices on futures exchanges were in freefall, some reports noted that the price for actual physical metal was behaving very differently. In fact, in some areas where physical bullion was scarce, the premiums, the amount you pay over the spot price, actually rose. This highlights a major disconnect. The price you see on your screen is not always the price you can get if you want to hold a gold bar in your hand. The paper market is driven by derivatives, algorithms, and leverage, while the physical market is driven by real-world supply and demand. On this day, the two were worlds apart. The event also taught us a powerful lesson about market psychology. It showed that even assets considered to be the ultimate safe havens can experience terrifying volatility. When a market becomes too crowded, when too many people are making the same leveraged bet, and when high-frequency, algorithm-driven trading dominates, things can unwind with incredible speed. The calm, stable reputation of gold was shattered, at least temporarily, reminding everyone that in modern markets, nothing is immune to rapid, violent swings under the right conditions of stress. So, let's summarize why this event is so important to understand. First, this wasn't just a simple price drop in technical selling, not by a slow, rational correction based on new information. It was a mechanical failure of the market structure itself. Second, the losses were both rapid and deep. We're talking about trillions in market value being erased in hours, sometimes minutes. This is incredibly rare for assets like gold and silver, which are normally seen as stable stores of value. It served as a wake-up call about the hidden risks lurking within the financial system. And finally, this episode provides critical market lessons. It proved that so-called safe havens are not immune to these rapid swings, especially when leverage and speculative fervor take over. It is a powerful reminder that risk management and understanding the structure of the markets you're trading in are absolutely paramount. The story of this crash isn't just about numbers on a screen, it's about the very mechanics of modern finance and the dangers that come with it. Thanks so much for watching. I hope this breakdown gave you a clearer picture of this incredible market event. If you found this interesting, please hit that like button and subscribe for more deep dives into the world of finance. Let me know your thoughts in the comments below.